Ever wondered about that little piece of plastic in your wallet? What exactly is a credit card, and how does it all work? Today, we're demystifying credit cards, breaking down everything you need to know, from the basics to the nitty-gritty details, so you can use them wisely. So, let's start at the very beginning. What is a credit card? Simply put, a credit card is a payment card issued by a financial institution, like a bank, that allows you to borrow money to make purchases. Think of it as a pre-approved, short-term loan. When you swipe or tap your card, the bank pays the merchant for you. In return, you agree to pay the bank back later. This is different from a debit card, which pulls money directly from your bank account. With a credit card, you're spending the bank's money, not your own. Now, how does this process actually happen? It seems like magic, right? Well, it involves a few key players. You, the cardholder, the merchant, where you're shopping, the acquiring bank, which is the merchant's bank, and the issuing bank, which is your bank that gave you the card. When you make a purchase, the card reader sends your information through a payment network, like Visa or MasterCard, to your issuing bank. Your bank then checks if you have enough available credit. If you do, it approves the transaction and sends the approval back to the merchant. All of this happens in just a couple of seconds. Later, the merchant gets paid by their bank, and your bank adds the purchase amount to your credit card bill. So, what is a credit limit? Your credit limit is the maximum amount of money you can borrow on your card. When you first apply, the bank determines this limit based on factors like your income, your credit history, and your existing debt. It could be a few $100s or many thousands. As you use your card and make payments on time, your bank might decide to increase your credit limit, giving you more spending power. It's important to stay well below your credit limit, as using too much of your available credit can negatively impact your credit score. A good rule of thumb is to keep your credit utilization, that's the percentage of your limit you're using, below 30%. Alright, let's talk about the bill. At the end of each billing cycle, which is usually about 30 days, your bank will send you a statement. This statement lists all the purchases you made during that cycle, your previous balance, any payments you made, and your new total balance. You'll also see a minimum payment due and a due date. The minimum payment is the smallest amount you're required to pay to keep your account in good standing. However, and this is super important, if you only pay the minimum, the remaining balance will start to accrue interest. This brings us to one of the most crucial concepts of credit cards: interest, or APR, which stands for annual percentage rate. The APR is the price you pay for borrowing money. If you carry a balance from one month to the next, your bank will charge you interest on that unpaid amount. Credit card interest rates are notoriously high, so carrying a balance can get very expensive very quickly. It's how people can end up in debt. The secret to avoiding interest charges altogether: pay your statement balance in full, every single month, before the due date. Pay ASAP, if able, or no later than a week before the due date. If you do these, you're essentially getting a free, short-term loan for all your purchases. This period between when your billing cycle ends and when your payment is due is called the grace period. So, why would anyone want a credit card if there's a risk of debt? Well, when used responsibly, credit cards offer a ton of benefits. First and foremost, they are essential for building a credit history. A good credit history is necessary for getting future loans, like a mortgage for a house or a loan for a car, and often at much better interest rates. Lenders look at your credit history to see if you're a reliable borrower. It's a part of analyzing the risk factor. Consistently using a credit card and paying it off on time is one of the best ways to prove that you are. Beyond building credit, credit cards offer incredible convenience and security. Carrying a large amount of cash can be risky. If it's lost or stolen, it's gone forever. But if your credit card is lost or stolen, you can simply report it to your bank. Federal law limits your liability for fraudulent charges to zero. Banks have sophisticated fraud detection systems that monitor your account for suspicious activity, adding another layer of protection that cash and even debit cards don't always provide. And then there are the rewards. This is where credit cards can get really fun. Many cards offer rewards programs to incentivize you to use them. These can come in many forms. Cashback cards give you a percentage of your spending back as a statement credit or a direct deposit. For example, a card might offer 2% cashback on all purchases. If you spend $1,000, you get $20 back. Travel rewards cards let you earn points or miles that can be redeemed for free flights, hotel stays, or other travel-related perks. Some cards offer points that can be used for gift cards, merchandise, or other experiences. Choosing the right rewards card for your spending habits can literally save you hundreds or even thousands of dollars a year. Let's quickly touch on the different types of credit cards you might encounter. Besides standard rewards cards, there are secured credit cards, which are great for people with no credit or bad credit. With a secured card, you provide a cash deposit that usually becomes your credit limit. It's a low-risk way for banks to help you build or rebuild your credit. There are also balance transfer cards, which often come with a 0% introductory APR. These allow you to move high-interest debt from another card, giving you a window of time to pay it off without accruing more interest. Student cards are designed for college students who are just starting their credit journey. And business cards are for small business owners to keep their business and personal expenses separate. So, to recap the entire process, you apply for a card and get approved with a specific credit limit. You use the card for purchases, and the bank pays the merchant. At the end of the month, you get a bill. To avoid interest and build a good credit score, you pay the entire balance by the due date. If you can't pay it all, you must pay at least the minimum, but the remaining balance will be charged interest. Over time, this responsible behavior shows lenders you're trustworthy, improves your credit score, and unlocks better financial opportunities in the future. Plus, you get to enjoy the security and rewards that come along with it. Credit cards are powerful financial tools. They can be your best friend for building wealth and managing expenses, or your worst enemy if misused. The key is understanding how they work and being disciplined. Always spend within your means. Track your spending, and make it a non-negotiable rule to pay your balance in full each month. If you do that, you'll be well on your way to mastering your finances. Thanks so much for watching. I hope this breakdown helped you understand the world of credit cards a little better. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more financial tips. Let me know in the comments if you have any questions.